Hi, this is Russ Squire again with 1031 Property Exchange, and we will continue with part 3 of using 1031 exchanges to grow your real estate wealth. And this is without a doubt my favorite part of the seminar because we get right into the tactics and tips and things you can use to increase your wealth. And these tips don't get put out there a lot, so it's I think hopefully everybody will find something in here, a little nugget of wisdom they can use and implement in their own real estate investing. So we'll exchange super tips. So I'm going to summarize these first. Tip number 1, using the lease option to avoid dealer status that forces full-time developers to pay ordinary income tax on gains. I call this the part-time developer strategy. Number 2, buying a vacation home in paradise tax-free using 1031 and that would mean in combination with 1034 exchanges. I call this the paradise strategy. Tip number 3, how to take cash out tax-free from your 1031 exchange. Call this the tax-free cash out strategy. Tip number 4, building your dream home using 1031 exchange and 1034 rollover. Call this the dream home strategy. Tip number 5, buying your kids a home tax-free, renting it to them at 20% below the market, and then converting it later to a personal residence. I call that the sweetheart strategy. Tip number 6, how to save big bucks by turning a build-to-suit exchange into a delayed exchange. I call that the home builder strategy. Tip number 7, the conservation buyer strategy. Combining 1031 exchange with a conservation easement, or what we oftentimes call the ranch buyer strategy. So all these tips are just, pure gold for real estate investors. So hopefully one of these tips will suit your circumstance and you'll be able to implement and use it in your own exchanges. First, let's talk about the tax-free cash out from the exchange. What you do to get tax-free cash out of an exchange is you refinance your relinquished property or the property you're selling before the exchange and take out the cash. And then you roll all the remaining net selling price into replacement property. So that's one way to do it. The other way to do it is to refinance the replacement property after the 1031 exchange is completed and take out cash without having to pay taxes. So once again, warning, you cannot take cash out during the exchange. That creates a taxable event. But these are legal techniques that will give you protection under the IRS safe harbor rules. So you can get cash out of an exchange using either one of these techniques. Buying a vacation home in paradise tax-free. We see that a lot of times here in Montana. But anyway, one of the ways you can do that, use a 1031 rollover from an investment property you own to buy a unique vacation property or dream home. You can attempt to rent the home, and the key word here is attempt, or place it with a property manager. You can then use it, but no more than 2 weeks a year for, the first 2 years is the best. And then you can add an additional up to 2 weeks for what would be called marketing and maintenance visits. So you could get about 4 weeks a year out of it. But a letter from your realtor can help document these visits, or from a property manager. But be careful, because the IRS does audit utility records. And if they see no rental income for the year and they see 8 months worth of utility bills, chances are they're going to throw the A card at you and you're going to get an audit. So you want to file 2 Schedule E and 2 4562 attachments to your income taxes on the property prior to converting it to personal use. And then you can convert the property in the second year, or following the second tax return is probably the better and more appropriate way to put it, into a personal residence tax-free. You can then bring in the equity on your primary residence by selling it using the 1034 rollover or exemption, and bring the dream home debt down to 0, and then convert the dream home into your home in paradise, your primary residence. So this is a great strategy for people who are maybe retiring, thinking of living someplace else that they'd like to be, like a warm climate like Hawaii, or maybe if they like to ski, maybe someplace like Deer Valley. Who knows? But it is a strategy and it does work. Using the lease option to avoid dealer status. So there was a Supreme Court decision called Mallet versus Riddle, 1966, and what the Supreme Court said was that to be a dealer, your first purpose, your chief principal, primary, and only purpose must be to sell. So The lease option, if you properly structure a lease option, you avoid dealer status, and they are the single best way to avoid dealer status in a selling situation. So, avoiding that dealer status will allow the seller to do a 1031 exchange. Now, the option agreement should make reference to the lease, but the lease should not make reference to the option agreement, and that's important. The lease should be for at least 2 years. You've got to have that 2-year holding period. And then, in conclusion, the lease option can help developers who do not develop as a primary form of business sell developed property and avoid dealer status. The downside is, you've got a 2-year holding requirement under a lease arrangement. The upside is you save a lot of money on income taxes. The sweetheart strategy for aging parents, and this is one as the baby boomers move into retirement, have grandchildren or children with young kids that are struggling to both make what their parents did and be able to afford a home. This is a beautiful strategy to help solve that problem. So what you do, you buy a second home with a 1031 rollover near your children and your grandchildren. Let's assume they're renting an apartment and they can't afford it and they need more space, and now they've got a couple kids, but they can't afford a home of their own yet because they haven't saved up enough down payment. So what do? Buy that home. You can then rent it to your children for up to 20% below market rents, and the IRS says that's completely legal. Grandma and grandpa can even gift up to $14,000 per year per child, grandchild, daughter-in-law, son-in-law to use as they see fit. Now, they could use that money to pay the rent. They can use that money to, save up their own, obviously their own down payment, fairly quickly over a couple-year period. Save up the down payment to get into that home of their own. So grandma and grandpa can visit or live in that property as much as they like. I mean, who's keeping score? It's rented. So you're really just a guest. You can also convert the property after 2 years of renting it to the kids into a personal residence tax-free if you want to move up and be near your children and grandchildren. Or after you've held it for 2 years and converted it to personal residence, you could even sell it to your kids. You've met the time holding requirement. Nobody's keeping track at that point. If grandma and grandpa decide they want to make the property a personal residence, they could sell their previous primary residence and use a 1034 rollover to reduce the debt on the property to zero. So there's a lot of options with the sweetheart strategy, but it is just a great strategy for really helping out, the next generation and the next generation after that. Combining a 1031 exchange with a 1034 rollover to construct a move-up home. So you own a home with 100% equity, and let's say you have a rental property with 50% equity. So the first year you sell the rental property and use the cash proceeds from a 1031 to acquire raw land for a dream home. Year 2, you can do base improvements, road, electric, gas, sanitary, whatever you like. And then finally in the 3rd year, after filing 2 tax returns, you convert that piece of raw land into personal use, tax-free, and then you list your primary residence. You begin construction in that dream home, and you use a 1034 rollover from the primary residence to pay off the construction loan for the new primary residence that you built. So all kinds of ways to solve all kinds of problems with 1031. You just have to know what you're doing and what's within the realm of legal. Builder's delight. Now this is a good one for people that are home builders, how to turn an expensive build-to-suit exchange into a delayed exchange and save a bunch of money. So a builder is attempting to complete a 1031 exchange, having sold a rental property, and is now trying to construct a new rental home on raw land within the 180-day total exchange period. So the builder has nightmares, they're experienced, over doing another build-to-suit because what happened was the exchange intermediary was slow in dispersing funds to satisfy the builder's vendors. And as anyone knows that's been in the building industry, the subcontractors are your lifeblood. You got to keep them loyal, and you want to keep the best ones around. The best ones come around when they get paid on time. Plus the exchange costs the builder $6,000 because build-to-suit exchanges are expensive to set up. There's a lot of accounting, a lot of disbursements, and it's all being done by a third party who's charging you. Our builder now can refinance the property they sell prior to its sale and take out the cash necessary, the cash equity to complete the improvements of the property they are building, tax-free. The builder then controls all the money necessary to complete the improvements instead of the qualified intermediary, so they don't have any vendor issues. Builder completes the new structure within the 180-day exchange period, and builder then saves about $5,000 in exchange fees because it's now just a standard delayed exchange. Conservation buyer strategy. As land costs create a lack of economy for traditional farm and ranch uses, or certainly in the mountain and resort areas of the West, large ranch buyers have become the economic elite, often with substantially different objectives from the mainstream ranch establishment. And conservation buyers are often interested in conservation, fish and game, preserve management, or enhancement, and just solitude with no intention of ever developing the property. So combining 1031 exchanges with the tax benefits of conservation easements can allow you to acquire a large ranch for a fraction of the cost of the listing price out of pocket, because not only are you using a 1031 exchange and saving all the tax dollars on the property you sold to acquire the farm and ranch, but you're also using a conservation easement. Now, the easement doesn't have to come into play prior to the purchase. I mean, the easement credits are going to be good for years to come, but it can make a huge difference in purchasing a larger parcel of land. In part 4, we'll discuss the property reinvestment decision. Would like to consult us on any of these strategies or have any ideas or need any help with exchanges, just give us a phone call, area code 406-425-2742. This is Russ Squire with 1031 Property Exchange.